It's impossible for someone with a lower income or limited savings to build a 1 crore wealth kitty. This is a widespread belief, but what if I could prove it's possible? The key lies not in increasing your income, but in making certain behavioral changes. Why focus on the character change instead of increasing the income level? It might sound unbelievable, but even with a small saving of just 5,000 rupees a month, you can create a 1 crore corpus. By changing how you think about money. Yes, you heard it right. In this video of 3 sections, I will show you what are these small but powerful character changes that can lead to significant financial growth. And in the second section, I will also show a live calculator working on how to invest this 5,000 rupees every month to create a 1 crore corpus. In the third section, I will show you one common mistake while doing SIP. Most of us may not even have recognized this mistake and we continue committing it. And because of this, you are not able to compound your money. I can assure you this is a very practical video with simple but very actionable 3 points. So do watch it in full. Please leave a comment on how you felt. When you make some quick profits, it becomes incredibly intoxicating. It tempts you to withdraw it because you want to protect the profits. You fear you may lose it back in market crashes, or it could be to satisfy an immediate desire like buying a phone or buying a TV or going on a holiday. These two impulses, that is the fear of loss and the lure of instant gratification, these are the biggest obstacles to the power of compounding. If you have to compound, you have to overcome these two biases. When market corrects, when markets are volatile in short term, please see the history. Every big correction is followed by a bigger market recovery, and it goes up even further, even in a bigger way. This is how, for the past 25 years, there are funds that have given an annualized return of 18% and more. Suffering the pain in the short term is the first character change that is required to create wealth. Avoid temptation to withdraw funds prematurely. Focus on the long-term goals and resist market fluctuations. Cut the noise, do not read too much. Section 2. I will show you using this live calculator how you can compound a 1 crore corpus with a simple monthly saving of 5,000 rupees. So to hit 1 crore corpus, let me input 25 years and the expected rate of return as 12%. The monthly SIP required is 5,322 rupees only. Now, if you invest 5,000 rupees monthly and you're willing to increase this by 500 rupees every year, which means the second year onwards, your monthly SIP would be 5,500. And in the third year, you increase it by another 500 rupees to 6,000 rupees monthly SIP. And the subsequent year, 6,500, then 7,000 rupees monthly for the next 12 months, so on and so forth. At an assumed 12% rate of return, you will be able to hit 1 crore in 20 years. That's 240 months. Now, there are mutual funds that have given returns between 16 and 18% annualized over the past 20 years. This would mean that a 5,000 rupees SIP with a 10% annual increase, you would be able to hit this target of 1 crore in about 17 years. Of course, nothing good happens overnight, so having faith in the long term becomes very, very key. By adjusting your SIP contributions and aiming for higher returns, you can significantly reduce the time required to achieve your financial objectives. In this last section, section 3, I want to share the research done by White Oak Capital on what happens to investors who are investing in the best mutual funds. Most retail investors go to financial websites, fintech sites, and look for 5-star funds. They look at the best performing fund. The site tells you which fund has delivered maximum return in the past 1 year. They normally then give a 5-star rating for such funds that have done well in the past 1 year, 3 years, along with other financial metrics. Now, no one can predict which fund will do well in the future. It's just a coin toss. So, this is all post-mortem. Assume you have been following the best funds for the last 1 year return and you decide to invest in such funds. And whenever a fund drops in its performance, you cut it and you switch it to the next best performing fund. Let's see what happens here. Well, if you need the original copy of this research, please ask for it on this email and I can share it with you. The first case, the investor had a SIP in the mid-cap index fund because it was the best performing fund. He then annually switched this to the best performing index of the previous year. For example, 2008 to 2010, he switched to large cap fund because that was the best performing fund. Then in 2011, he switched to small cap fund because that was the best performing fund the previous year. Then he moved to the large cap fund and then to the mid cap. Then he switched back to small cap, then to mid cap fund, all because the best performing fund simply kept changing. The final XIRR percentage for this investor was 15.5%. Conversely, if the investor had continued his SIP with the mid-cap index fund with which he originally started without switching, then the XIRR percentage would have been 18.1%. The difference is 2.6%, which is very, very significant over the long term. 2.6% can add a lot of wealth when compounded over 20 years. So it is actually a big loss for an investor who actually thinks he was always investing in the best performing fund. This research is brought to you by White Oak Capital, and I can share the full report if it is of interest to you. Just email asking for the White Oak Changing Lane SIP report. A similar trend can be seen with the second case study for an SIP started in the small cap fund. Let's say the investor started with the small cap index fund, investing in that, and then next year he moved to the mid cap fund as the mid cap exhibited the best performance criteria over the previous 1 year. Then 1 year later, the best performing fund was the large cap fund. So the investor then switched his funds and moved to large cap fund. Large cap continued to be the best performing fund for the next 3 years. And after that, the best performing fund was the small cap. So the investor switched again from large cap to the small cap fund. Again to the large cap, then to the mid cap, large cap, small cap, mid cap, small cap, mid cap, large cap, small, mid. All along, he was satisfied that he was always investing in the best performing fund, only to know later and be disappointed that if he had done nothing and simply stuck to the small cap, irrespective of it not being the best performer in few years, he would have generated a healthier return of 16% versus 15% on account of continuous switching. However, the human mind is unable to accept inaction as productivity. The mind associates continuous action and continuous decision to productivity and efficiency. Unfortunately, as research data shows here, it is otherwise. Many investors ask, what should I do now? Should I book a profit? Should I sell now and buy later? And the answer most of the time is do nothing. Sometimes it is not considered a good advice, but good advice many times is simple. As they say, investing is simple but not easy. Frequently changing lanes can be both stressful and harmful. Therefore, SIP investors should focus on reaching the ultimate financial goals by continuing the SIP over the long term. It would be beneficial to have a coach who can manage behavior and not one who can tell you which is the best performing fund, as you would have realized from this research. Behavior and how you think about money is more important than historic returns and all other financial metrics. That's why Morgan Housel said, financial success is not hard science, it's a soft skill, where how you behave is more important than what you know. So the next time when you decide to look for the best performing fund, Give it a second thought. Instead, look at why you are saving. What are your goals? Internalize this lesson. That way, you can keep your mind at check and compound peacefully. If you would like to invest in mutual funds based on your own unique goals, your unique life situations, and your unique risk profile, you will need to customize a bespoke portfolio. Please email here or register here. Consider liking this video, subscribing to this channel, and sharing it with your friends.